Started. Hello, everyone. Please be advised that today's webinar will be recorded. Thank you so much for being here today. My name is Maricela Zambrano, and I'm a relationship manager at the Southland Development Authority. And I'm excited to be your moderator for today's webinar, which is part of our Think Like a CFO series. And today we're going to be focusing on business financial fundamentals. And we do have a agenda today, so we're definitely going to get started. And we do expect to have like some sort of questions. So if you have any questions throughout the presentation, please feel free to drop them in the chat and we will address them in our Q&A section at the end of the presentation. So for those of you who are new and are not familiar with the Southland Development Authority, we're a non-for-profit business organization. We were established in 2019. We oversee 45 municipalities in the South suburbs with a mission to drive the economical growth and development of these suburbs, and to do so inclusively by bringing you resources and educational cohorts such as this one. As a relationship manager with the SDA, I serve the Business Growth Service Unit, where we strive to provide special programs, one-on-one tailored expert consulting, community partnership, and business educational and cohort programs to business owners within our municipality and in the Cook County areas. And in order to do this more effectively and make sure that we tailor these type of resources and educations that you desire, we have developed a business needs survey. So to capture your insights, we ask that you please scan the QR code on the screen to complete the survey to help us tailor our programming to meet your needs. Today, we're so pleased and excited to have Mr. Stanley Jackson from Jackson Melton LLC with us. Stanley is the founder and managing partner at Jackson Melton LLC. He leads a team that offers clients everything they need for valuation, merger and acquisition, restructuring, and tax advice. With certifications in restructuring and business appraisal, Mr. Jackson helps companies preserve, recover, and/or maximize their value. So he guides clients through complex legal matters like bankruptcy and security laws, believing that understanding finance is crucial in these situations. So Stanley's expertise covers a wide range of valuations related transactions, making him a trusted advisor. And we're so happy to have him here. Today, he highlights that the goals will be to introduce the 6 business surveillance techniques CFOs will use to maximize their value of entities. So without further ado, I will hand it over to Mr. Jackson. Stanley, the floor is yours.
Thank you, Maricela, for that introduction. I'm glad to be with you guys today. It's funny how this world life goes full circle. I was once a relationship manager. I'm an alum of the SDA myself. Worked with the team to get the organization up and running in the midst of the pandemic back in the spring of 2020. Since then, as Maricela has kind words that she shared with you, I am the founder and managing partner at Jackson Melton. I am a licensed attorney, and I have a background in corporate finance. And I found my space in the law when I took my first corporate tax class in law school. And ever since then, I've been on a mission to try to fill a void for small and mid-sized companies, especially the ones that are littered across the Southland, because there's always been a lack of financial resources from an intellectual perspective in these businesses. You go into the average business, you'll see an operations person, you'll see a leader at the GM or CEO spot, and you might find an accountant or a controller, but no one that is really in charge of the CFO type of silo or vertical, where you're looking to drive value in an organization. You're trying to increase the value of the hard work that entrepreneur or that family's put in for a long period of time in a particular enterprise. So today, I want to introduce the audience to what I call 6 business surveillance techniques that the CFO is constantly using to help a business get from point A to point Z in their business life cycle. We can move on to the next slide at this point here, and we'll start with what I believe is the central command for business decision making, which is the business life cycle. And Maricela, can you forward to the next slide?
Yes, I'm attempting to go forward and it seems to be a little bit frozen. So just give me 1 second here while I fix this.
Beautiful. Yeah, so these 6 techniques that will be introduced on the next slide all come back and speak to this graph here on the screen. Anytime a business, wherever they are, they can be mapped to some point on this chart. If you're a mature 50-year-old business and you were launched 50 years ago, you've gone through a growth cycle and you survived through what might have been some turbulent times. So you're a mature business. And when you're a mature business, as you know, at the top curve on that graph shows, you're going to have to try to reinvent yourself so you can get some growth. If you find yourself on the decline, you're going to have to come up with a new strategy at some point in time. And I guess a good example is that it's like the auto industry. The auto industry, everyone was buying a gas-fired car for the last from 1920 to 1980. Then at some point we had, oil crisis throughout those time periods. So there became an idea like we might have to electrify the vehicles in the world. But the oil industry wasn't happy about that, so that became a competitive factor for the launch of the electric auto industry. But eventually, it got there. Or you're a small startup and you got an idea. You want to open up a shop in a community. You're gonna have to look and say, I want to launch this business. What are the inputs I'm going to need? What are the back office things I'm going to need? What's my marketing plan going to be? And what is this product or service I want to distribute to my local community? That's what a small entrepreneur has to go through. So they're going to have to be like, I'm in the launch portion of this graph, and then I have to figure out what it is that I need to do from a competitive standpoint, figure out what kind of organization I'm going to try to build or what kind of entity I'm going to have. Am I going to be a sole proprietor? Am I going to be an LLC, or am I going to be a small corporation? In addition to figuring out what the organization is going to look like, I have to budget for what financial resources I have and what investments I can make at that starting point. And once you do that, if you start growing, you got to start thinking about ideas of what kind of culture I want to have in my organization, and what kind of innovation strategies I want to have to keep my business fresh and new. And then you're doing all this. So one day you're going to have to ask yourself, what is all this work worth? What is my business worth? What is my idea worth? And then monetizing your idea or your business, if you want to build wealth for your family and the community, the most optimal way to do that is to sell your organization or sell a piece of your organization and capture and lock in the value that you've created so you can live a more prosperous and fruitful life. Now let's dig into some of these surveillance programs. I'm using that word because I want to make this I don't want this to be intimidating anyone. Some people think high finance is intimidating. The things they read in the Wall Street Journal are intimidating, or the things they need to be aware of. But my goal is to make this understandable, where you can digest it and quickly take these tools and implement them in your business. So the 6 surveillance techniques. Number 1, the competitive analysis. Competitive analysis. Are you informing yourself on every possible thing that's within reason? Because you can't know everything. A lot of entrepreneurship is about solving problems, including the problems you're going to come up with as on your journey, or the ones you're going to come across. These are like I said. So if you're a CFO in a business and you're thinking about making a decision that's going to impact your company or your business, either on the short run, medium term, or long term, you're going to want to do the homework it takes to understand the market you're engaging in, your competition you're engaging with or against, and understanding the jargon, vernacular, and all the customs and traditions that industry or market has enjoyed, because nothing's new under the sun. We're just repackaging things to some degree, or reapplying some of the things that we have. So keeping that in mind. Once you figure out, again, I'm repeating myself a little bit, then you got to move in designing an organization, designing that entity to take advantage of the opportunities that you find from doing that competitive analysis. Once again, you want to be able to formally have some kind of program, a systematic approach to all these, using these techniques. You have a systematic approach so you can start surveilling and getting that information about your business whenever you're going to make a decision. Because every time you make a business decision, in most cases, you're either going to create or destroy value. So these tools are there to help the CFO do more positive things for the enterprise than negative things over the time that they're in that leadership role. So let's dig deep into the first tool, competitive analysis. CFOs use these business surveillance techniques to identify benchmarks for measuring the firm's effectiveness in either creating a more valuable organization, and that's usually going to be married to execution of their strategy. They're going to do what it takes to find out what the competition is up to, or what is necessary to be the dominant competitor or player in a particular place or market, and understand what those latent risks that are not obvious are, that are for a specific industry or market, and do what it takes to manipulate or manage or mitigate those risks as best as possible. But there's also risks that you will never be able to mitigate. We're 3-4 years removed now from a big shock to the market, and it was a shock that affected every business across the world in some form or fashion. Just recently, yesterday, the port in Baltimore just got shocked. So that's going to have a local shock wave through that market directly, and then it might impact other parts of the global supply chain. So those are things that you might not be able to directly mitigate, but these are macro level issues. So digging into what competitive analysis should entail, you should do all the qualitative analysis where you can dig into trade publications, industry reports, anything that's going to provide you information, data pertaining to trends and innovations or things that are afoot in a particular landscape that you're going to be trying to go after. Quantitative analysis. Quantitative analysis is understanding what those standard metrics or measures that the industry uses out of basically custom. For example, I had a short stint in the airline industry, and we've all gotten on an airplane, or most of us probably have gotten on an airplane at some point in time. And the airline industry is notoriously one of the most difficult and complex industries in the world to operate in. Those, we have, like, for example, every airline uses the same common metric to measure their performance. On-time arrivals, which is regulated by the government to some degree because they can get fined for too much tardiness. And then from a financial perspective, they use this metric called revenue per available seat mile. So they got all these miles that they can fly across their network, how much revenue are they generating per seat, per passenger, and then they know what kind of cost it takes to have an available seat mile. So they understand the cost structure, they understand the revenue structure, and they can make decisions going forward. And every time they're trying to make a decision, they're also going to have to look at the macro level issues at bay, like what's the global economy looking like? Do we have a lot of geopolitical risk? Because right now, flights in the Middle East are going to, they stopped flying in the Middle East for a while because there was a flare up in on the war front. Then there's micro level issues like, you have an airline with hubs all over the world. You have to comply with, just to remodel a hub or put that club service inside of the airport. You're gonna have to get a permit for that. You're gonna have to deal with local vendors that are qualified to do the work because of some local ordinance or state regulation that you have to comply with. So these are the things that an entrepreneur, a business owner need to be aware of and able to ascertain this type of information to be as informed as they can be in making a business decision that's going to impact their business. We can move on to the next slide. So in addition to these soft and quantitative things that you do to get information about your business, you got to understand how to design a system that gets your product to market or your service to market. And I believe firmly that almost every enterprise that you come into contact with as an attorney, as a financial advisor, as a valuation expert, I'm always going to try to distill the enterprise down to the simple four-pronged system. Every enterprise can get distilled and expressed this way. So when a client can go reach out to the SBA for services, or they come to Jackson Melton or any other consultant or service provider, you want to be able to simplify your business so everyone can understand it, and you will probably understand it better, because when you look at an issue that comes up in your business, it should fit into one of these four buckets. And on the left, if you're seeing the screen, it's the marketing program for your business. And then every other business also has to have a place where they manage the resources and inputs and inventory. That's your supply chain. And then there's back office functions like your administrative functions, like legal, HR, compliance. And then the production is, if you're a manufacturing system, you gotta have your lines, your plant, your facility that's making widgets or whatever your product is. If it's a service, you gotta have a system where if it's scheduling, reservations, if you're a housekeeper or you're a cleaning, you got a cleaning service, you gotta know on Monday, logistically, I have to be in this neighborhood, and I have these homes that I have to service. Or, this, like I said, this applies to any business. If you're an auto manufacturer, you got to design that hot car that everyone's going to want to buy. You're going to have to manage a very diverse supply chain of input parts, engines, all coming together to be assembled at your facility. And then there's a lot of administrative things to do in the back office. So the CFO mindset is to view those four baseline functions of the enterprise as the places that value can be driven through an organization. So if the CFO wants to be able to monitor all these aspects of the company, he wants to know, is the sales team getting out there, originating new relationships? What's the clip, so I can kind of forecast what our revenues are going to look like? Then he wants to understand the supply chain. That's going to be the cost and input cost for your business. Are we getting the best pricing for those raw materials? Are we getting our clients delivering, our vendors delivering the, 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 the products within the specifications that we require? And if not, how do we settle that or get that under control? And that might be a phone call to a legal department inside the administrative function, and then the accountants to go through, the invoicing to that supplier and figure out what's going on. And then on the production side, of course, he wants to make sure he has the most efficient production system so you can actually maximize the profits of producing the good or service. So that summarizes pretty much the competitive angle of understanding the outside things that are influencing your business from the CFO's vantage point, and then taking that information and understanding how it's going to fit into the entity and how it's going to look from. And this is the point. We want to have, what kind of entity am I going to do the competitive analysis for? I'm going to build out an operational system that entails marketing, supply chain management, admin, and production. What is going to be my choice of entity to do this from? Now, take note on this screen, there are four shapes. There are four entities that are kind of distinguished here. Three of them have a shape and some color around it. And we're going to get into why that is. Professor Quall at Loyola School of Law taught us that a proprietor is naked, because a sole proprietor is kind of the default business entity for someone who opens up a shop, has a cash register, takes in income, has expenses, but doesn't go through the formalities of registering their business with the state of where they operate or the local municipality. And when I mean, they might register with local municipality and get like a local business license, but at the state level, and particularly the Secretary of State, if they bypass any kind of registration with the Secretary of State, they're going what we call naked. They are personally going to be liable if anything might go wrong or against them operating their proprietorship. Now, LLCs, S Corps, and C Corps, on the other hand, are what we call legal entities that a business can formally register as. An LLC is usually the entity of choice for a partnership where two or more people are going to come together, pool their energy for a common goal of seeking profit in a particular lane or space. Now, there are single member LLCs that are permitted in most jurisdictions. And there's one thing about an LLC that everyone should keep in mind. A limited liability company is not a perpetual entity. That means they are designed to come to an end for the most part at some point in time. So if I and my partner were in a business and one of us were to pass away, technically that LLC would be dissolved almost automatically. But there are triggers in there if you've got good counsel to keep the enterprise going. But there will have to be some kind of transition or that will have to be made upon certain events with an LLC. On the other hand, corporations they're never-ending entities so long as they stay in good standing. And there's two types of corporation. One's a subchapter S corporation, and the other one's a C corporation. They have some distinction. For the most part, S corps are generally the default for closely held, privately held companies that are small to medium size. There can be large S corps. There's no real size constraint, but they are limited to the amount of investors they can have, usually up to 100. And this is chosen because an S corp is what we define as a pass-through entity. In other words, you'll report your revenue and income informationally to the IRS, but the profits or losses will be attributed on a pro rata basis to the owners, and their taxation with S corp structure is usually once, and that's at the owner level. A C corp, on the other hand, is generally for large publicly held companies that are on stock markets listed. Those are generally C corps, and or other entities that are looking to grow or assemble large amounts of capital. C corps is for companies that are looking to take on sophisticated institutional investors, because at the end of the day, you want to pour as much of those profits back into the business, grow the business, and then there's a big exit somewhere, shape, or form. So when you're looking to start a new organization, a new business, try to make sure you seek some counsel, seek some advice through an RM at the SDA, or they can point you somewhere. But just make sure. I personally don't like the fact that I hear overwhelmingly a lot of people choosing the LLC strategy or no entity, formal entity for their business, because that's dangerous for wealth protection reasons. And the LLC, it's not always the best, but it depends on what are your goals, and it's a case by case thing that needs to be sorted out. So I recommend everyone get some advice or get some counsel when it comes to making that decision, because it can have lingering effects. We can go on to the start of the capital budgeting process. Capital budgeting and planning. This is one of my favorite parts of this of being in this space as an enterprise professional. Finding where the value is in a business is something I really enjoy. So CFOs and the whole C-suite, and as a whole, with the CFO taking a lead role in that, uses the capital budgeting process as a way of selecting what investments the company will pursue with the goal of increasing the overall value of the business. One example is the underrated joint venture. Another thing, there's a myriad of decisions that the CFO has to make. And the first portion of this presentation, I want to use an example. And last week, did just a quick little search online. I came up with this newswire that came out where two companies that are in the auto industry decided to get together and do a joint venture where they would launch a new company focused on making automotive related technologies for electric vehicles, essentially. And that's Volvo, which is a Swedish auto manufacturer, and Renault, a French auto manufacturer. But it was just interesting how they're going to each contribute $300 million or $300 to a partnership. And we can use this example to teach some other things that we've just discussed and some new things. So we can move on, and we're going to go through what it takes for a CFO to structure a theoretical joint venture. Uh, so in this hypothetical, we got V company and R company. Both of them have, strategic things that they're good at. And they're like, we both manufacture X and we got expertise in certain things, but we don't have, all the, there's no such thing as free money. There's no such thing as endless money. But if, we're not as big as the big guys in this industry, but we might be able to partner together and develop something that can make us, a player in a particular niche. So V and R can enter a partnership agreement. And if you notice, the triangle there represents a partnership through an LLC. So V company and R company are going to partner together through a contract, and they're going to create a joint venture through this LLC. Each one of the companies are going to commit $300 to the partnership. So you're going to capitalize this new partnership with $600, and with the goal of launching production of VRX. I just made that up. And then inside that partnership agreement, if certain milestones are set and met, we're going to sell the joint venture in 3 years. So the CFOs of V and R are both saying we have to take the $300 that we're investing in this partnership, and we're foregoing other places that $300 can go. We could have kept the $300 in our business and made money off the $300. We could have put the $300 in, at our bank and just collected the interest on it. We could have put the $300 and given it back to our shareholders, and the shareholders could have done what they wanted to do with it. So we as stewards, we better show our owners, our board, our investors, everyone that we are going to do something positive with each of our $300 commitments here. So going back and referencing our organizational design slide where it had a marketing function, a supply chain function, an admin function, and a production function, we're going to fill in where this partnership can put its organization together through. It's a brand new entity, it's a brand new joint venture, and this is how this is going to play out. The V company in the marketing space is going to provide and contribute their product design expertise and their brand management expertise. And the R company is going to contribute access to their global distribution network and their robust sales team. So between the commitment of the sales team and the design and branding folk from B company, they collectively in this partnership have now covered what the marketing needs are to go after their opportunity that they've identified collectively. And they're spreading the risk. On the supply chain side, the V company has an idle plant. And they're like, we'll contribute that idle plant that's been sitting there dormant for 2 years or 3 years. We want to get a productive use of it. And then the R company is like, well, we got great purchasing and inventory relationships, and we got this worldwide network of vendors that can give us all the supplies we need, and they'll bring it into the plant that we're going to co-use or collectively use for this joint venture. On the administrative side, V company and R company can decide to get third parties to handle the back office functions such as accounting, human resources. They can hire a legal team and an IT team to take care of all the back office functions of keeping the system going while they go out and develop this new product. And on the production end, their goal is the B company and our company are collaborating to fabricate the VRX automotive chips or software applications that they hope that they do a better job at. And in 3 years, a larger player in the game or a larger, even a private equity firm or somebody, some large institution can see that the work that they did over that 3-year period is super valuable. It's a niche. It's going to solve some things for them. It's expertise and competence that they want, and it has value, and they will buy out the venture in 3 years, hopefully. Or this is the hypothetical. So let's go through some of the things that will be triggered by the CFO once they put this joint venture together. We can go to the next slide here. So on the right, we're going to just review a little bit. So the CFO is systematically, with these tools, monitoring what alternatives are available to the company. In many cases, the CFO is constantly the bellwether to make decisions such as, do we want to build the expertise that we need for this organization to get to its next destination, or do we want to buy that competence? That's kind of the merger and acquisition mindset, where, do we want to, build this expertise, or do we want to buy it? And which one is going to give us the greatest impact with the least cost and least risk, or time? Because time is always important to the CFO. Secondarily, do you want to sell expertise? You can get to a point in your business where you've created a niche of expertise, and it is time to possibly sell the expertise that you built and created. That's a little bit of, or trading that expertise, such as in this example, where these two entities are gonna, we're gonna barter essentially. We're gonna get together and trade and contribute our expertise in a way. Another common dilemma that is always on the front for a CFO or entrepreneur is buying or renting an asset. For example, you have a flower shop or a bouquet shop. I want to offer delivery to my clients in my footprint of service. For example, you go over to the auto dealer, and you got to ask yourself, do I want to buy this cargo truck or van outright and own it, or do I want to lease it? And that's where you go into the analysis. Is it a buy or a lease? Do I want to rent this asset or buy that asset? So that's a common dilemma. Or, in this hypothetical, the plant's idle. Maybe there's a plant that they needed to get, and that if they didn't have the idle plant, they would have to ask, okay, we got $600 here in our budget. Do we want to buy the plant to make the VRX, or do we want to lease the plant from someone? We only want to be here 3 years. We're not trying to make, you have to, so you're going to weigh the risk and rewards based on the facts and circumstances that are afoot or present in your decision-making time frame. Fourth, modernization and R&D. I'm reading this book, and I'm going to classic book. It's Barbarians at the Gate. And I'm rereading it, and it's like the bakeries. Bakeries make money, but when do you modernize your bakery? Is it if you had a bakery business, if you're Interstate Bakeries and you're making Hostess cupcakes or whatever, and your bakeries haven't been remodeled in 30 years, you past the depreciation of the useful life of the asset. It's been, you're hanging on by a thread with these bakeries, every day it's something to fix. You got to get to a point where it's like, I might have to shut down this bakery, retool it, find the capital to buy new ovens and things like that. So you get to a point, you got to understand the CFO is always monitoring these decisions. But capital budgeting, as I said in this slide, I show in this slide, the V company and our company, what's different in this slide, they have at 10% is next to this one. That means the V company is going to go out to the bank and they're going to borrow their $300 that they commit to the partnership. So, and the bank's going to be like, you're great, you're credit worthy, you're good. We know if we have to, we got the parent company and your main business to go after, but we'll give you $300 for this hot new joint venture. The R company, on the other hand, they just went and took the cash straight out the piggy bank, and it still has a 10% cost. But you're going to ask me, how is there 10% cost? Well, remember, if they kept the money in the business and they have continually made a 10% ROI on the business on a routine basis, if I give it to the JV, I'm losing the opportunity to make 10% by keeping it in the business or putting it in a stock or all the alternative places that $300 can be. So if being a steward of that $300, you have to make 10% or more to make it just to start over each year. So let's go through the economics on the next page of what this example would entail. Again, this is VNR, they enter a partnership agreement. The V company and the R company both have a cost of capital of 10%. So if we look at it on simple interest terms over 3 years, 10% of 60, or 10% of 600 is 60, times 3, simple interest is 180. 10% compounded over 3 years is just under 200, 198. So I basically am saying, like, whatever we do by year 3, this business, for it to make sense, has to at least just the 800 at minimum, but 1,000 is probably a target or reasonable objective to have, that I need to put the $600 into this joint venture and it has to be worth $1,000 in 36 months. So we got work to do. And as I mentioned, the CFO is looking at the cost of that money. So there is no such thing as free money from the CFO's perspective. So they must always understand how much the money is costing them in their business. Because if you start a business and you put $300 in the business, you could have $305 by just putting it in the bank. So the CFO must set what we call a hurdle rate, where any investment that you make in your business should return of greater than the cost of your money. So if you look at 20% being a hurdle rate, where they're like, okay, I got enough cushion where this project or this investment or anything I do in this business should give us at least a 20% return. So we know we've covered our cost of money and we're doing a project that'll be accretive in enhancing the value of the business. So the second concept that they're going to be looking at is, for example, and I'm simplifying this, is the payback period. Now, if I put $300 in the business and I'm going to try to sell it in 3 years, it would take $1,200 would be a full doubling of my money, but to get the $600 to get it back. So in 3 years, you got to calculate, okay, it's going to take at least 3 years to get my money back with the return. That's because under contract with my partner, we agreed that we're going to do this and sell it in 3 years. So I can get this money back to back to the parent companies that made this investment. Now, what if all hell breaks loose and there's no market for the VRX production that we had? Or we might decide, oh, we don't want to sell this. We got something really good. Let's figure out what we're going to do for the long term. So there's a wait and see approach. But on average, the goal is to sell the business and be able to justify the time that the money was tied up in the joint venture, and making sure that it's returning a profit or a higher rate of return on the investment than it is costing us on the capital. For example, I'm going to simplify this even further. If I borrow at 10% from the bank, and someone overheard said they want to put the money in the stock market, they must be getting more than 10% in the stock market to make that whole, to make that work. We can go on to the next slide here. So the key, though, is change management and strategy implementation. Also, another surveillance technique that the CFO wants to do. So the CFO is going to have to look at all these opportunities that they have, which is kind of endless to some degree. But you got to narrow the list of strategic alternatives down where you're making the choice that the risk and the reward are in balance. Where if you know that the probability of success is in your favor, and you're taking the least amount of risk and you have a high rate of return, that's what they want to do. And then the high risk or the higher rates of return have the most risk. So you got to look at what the risk tolerance is for you as the owner, you as the entrepreneur, and what you're willing to invest and what you're going to get back from that investment. So again, going back to those 4 big decisions that most CFOs are constantly thinking about: build, sell, rent, or modernize. They're gonna have to figure out, does this company have the capacity? Do we have the resources to implement the strategy or the investment? So, for example, in this hypothetical, the change management issues are, going back to the news clip, the V&R company in this hypothetical are basically 2 automotive companies. And a lot of people might not be familiar with Renault, which is a French automaker. And then Volvo is, known to be the safe car. They got a big presence in, they're actually a Chinese company now, Volvo, but they're based in Gothenburg, Sweden. Those are European auto manufacturers, and the EU has a different approach to labor than other manufacturers around the world. So they got to ask each other, will our rank and file support this joint venture? And furthermore, what is that going to do to the culture of our mainline business? And then being that it's a technology company, it's like, well, we might need to have a bunch of young, young developers in a room figuring out software issues. They're not going to be wearing steel toes, hard hats, and safety glasses. They might need to be able to play video games away from their desk so they can stay inspired. So that's culturally a little different. So it's like we're building out this technology business essentially, and we are mainline auto manufacturers. So we gotta it's probably better to do this JV where we can do this separate from our main businesses. If we were to go back to the business life cycle, V&R are both mature conglomerates looking for growth. They can't invest $600 or collectively or $300 in their business and get the 20 or 30% rate of return on a project because they're a mature business. They have legacy costs. It does not have as much economic upside, either financially or culturally, to keep this development inside their regular organization. Then they got to look at who are the companies out there that are pioneers in auto tech. Do we want to take their best practices and implement them in our new joint venture? Or we want to be radically different? Those are things that you got to make decisions on. And then, do you have the people and the resources to drive that change? And as small businesses and small and medium-sized business, that is on the personality, leadership, and people skills of the owner. If you're a charismatic owner, dynamic, and you can get people to buy into your strategy, because people do not like change. It's written about all the time. I don't like changing my cell phone because I got a new cell phone. I still haven't gotten all my emails on there because it's like I'm used to doing things a certain way, but I'm trying to just to get better at change myself, but it's a tough thing. And then anyone that's going through going from, say, working in corporate America to being an entrepreneur, that is in itself is a change. Are you accountable to yourself? Are you accountable to a team? So it's I just want people to always know there's some people and soft skills that are gonna be necessary to do system upgrades and do changes in your organization. And you can't discount them because they don't show up in the stat sheet per se. But if you're watching a basketball game and you see a couple of defenders hustling, doing all the dirty work in the game, those things that don't, like I said, show up in the stat sheet, they make a big difference. They change the momentum of the game. They make the big play. They get the big stop. They do the things that are necessary to make a difference in their goal in that competition. And then, do you need management from outside the auto industry? Well, or you need someone with a little bit of auto industry. So it's things like that, because that's going to dictate how your culture of this JV is going to be and how successful it's going to be. So the people element is very important. We can go to the next slide there. Oh, we're tight on time. I really got to keep moving here. Let's do, this is, again, how much is this worth? So when you're looking at a business, how much is it worth is very important, because why are you doing all this? So there's standards of value, there's valuation techniques that you need to be probably aware of. And the number one thing I say, it's not really common, but the replacement cost of enterprise. You gotta insure your business. Please insure your businesses. Make sure you're not doing anything that's gonna be detrimental that you can control. So there, right there, you gotta go talk to your insurance provider and say, I'll show you the receipts. This is $1 million company. If something was to happen, lost revenue, I got my business caught on fire, business interruption, I want the money to still come. That's what I'm paying this premium for. Cash is always king. How much cash does your business generate? And in that's a big value driver. Cash is king. That's never forget that. And then you want to performance test. If my business is running at a 60% operating margin and the industry, everyone else is at 48%, they're going to be like, how how you got 12% higher margins than I do? Or if you flip that, your margins might be 45% and everyone else's are 60. Why are yours short? So you need to know how to performance test and benchmark accordingly. And then situations where you need a certified valuation. Plain and simple, any SBA loan that's over $250,000 requires by law for the business to be appraised. So the bank is going to have to request that, and usually, just like buying a house, the lender wants to know that I'm loaning out funds that's for good use and for an asset or that I'm going to take collateral and I'm going to be covered. So let's go through some of the things that you need to know as far as being prepared to buy or sell a business. First standard of value that everyone should be aware of is the fair market value. That's the standard commonly applied to most business valuations because you're dealing with a willing buyer and a willing seller, and they're negotiating in good faith. So the buyer and seller are both, freely acting without duress. The buyer and sellers have complete knowledge of all the material facts. So you go through a business you're looking to buy or you're preparing your business to be sold, you go through it just like a house. You want to paint the house. You want to make sure that you got hardwood floors, got granite countertops. You got the things that the market wants to see in your business. The buyer and sellers are well informed about market conditions. In other words, we're in a high interest rate environment that we haven't seen in years. It's going to be persistent most likely for a while. So it's like everyone needs to be fully informed. So they're going to the fair market value. Other standards of value, like if you're dealing with a distressed business, we're looking at the liquidation value because if we can't restructure this business, we're going to have to sell off in a fire sale what's left of it, pay the creditors back, and then whatever's left is going to probably go. In other words, that's when the equity holders get wiped out for the most part. Fair value is where you're reporting, where I got inventory. That's the key one. If I got $1 million in inventory, last in, first out, or first in, first out accounting system, I'm gonna report at the end of the year on my balance sheet at its fair value because it's not a fair market, it's not a buy-sell situation. It's fair value, so I'm gonna report on an accounting basis or reporting basis what the inventory is worth. Strategic value is when I got that expertise or competence that is so good, everybody wants it. I'm gonna sell it, and I'm gonna get a premium for it. So the business has a baseline value. And then when you hear, I'm going to pay a premium, I want it so bad, I'm willing to pay 20% more than it's really worth. I'm still going to figure out how to make this a good part of my business on an acquisition. Or you sell your business for 20% over its fair market value because it's that damn good of a business. So these valuation approaches, in other words, there's usually a combination of 2 to 3 approaches, if not 4, depending on how sophisticated or how robust your company is. But from a baseline perspective, the balance sheet. At any point in time, the balance sheet gives you a snapshot of what the assets, liabilities, and equity are in your business. But on the left side of it, if you look at all the assets, that's a baseline book value of the business. If you got $1,000 worth of assets and you have no debt, that means you probably paid in $1,000 cash to that business, and then you took the cash and you bought inventory and you bought insurance, that was a prepaid expense. So you got everything on your balance sheet. So if you put $1,000 in your business, the business should be worth $1,000, roughly. And then if you earn money from the previous year and then you retained it in the business, so you got the original $1,000 plus profits from the previous year. So you turn a $1,000 business into $1,500 because you made $500 the previous year. So that's as you make profits and income, and it flows through the income statement and into the balance sheet, you can figure out just on a book value what the business is worth. P&L, your profit and loss statement is going to give you what the cash earning potential of the business. So if you look at earnings before interest, taxes, and depreciation and amortization, that's basically the standard for operating cash flow, cash generating ability of the business. And it's $500, you consistently can make $500 for 10 years on a periodic basis. Someone might buy that business at 500 at some multiple of the $500 stream of cash flow that you're generating. And then there's market-based performance tools where I can sample all the competitors in a particular space, figure out what their performances were based on their sales, based on their cash flow, based on their net profit. So you can find out, and then you can also say there's databases that say cabinet companies or wood shop manufacturers over the last 36 months have sold at two and a half times cash flow. There's databases out there. There's all kinds of things. So you find out those databases, you look at the P&L performance of the business and the balance sheet performance of the business, you can come up with, value of the company, the value of your hard work. Those are the ways of doing it. So again, this is summarizing it again, like on the asset balance sheet focus, where you normalize the balance sheet. What normalizing a balance sheet means, usually in a small business, ownership perks. If you and your family's vehicles are inside your business, we want to normalize that. That means if you're paying, car notes out the business, we're going to say, you know what, let's add that back. Let's adjust that. The new owner is, they don't need personal cars bought through the business. So you normalize the balance sheet, taking away some of the fringe ownership benefits and adjusting them to normal activity, normal operating activity on the income statement and actually on the balance sheet. And then from an income perspective, you want to, discounted cash flow and capitalized earnings. Those are, we can get those are presentations in and of itself, but as long as you're looking at the fact that the cash earning potential of my business, as evidenced from my profit and loss statement, is going to drive how much my business is going to be worth. And then, focus on the industry where, there's industry publications that keep up these things, but all together, you're evaluating the management at the end of the day. A business that's more valuable, the value of the business is going to be attributed to this management. So why have we been here listening to me rant about CFO surveillance strategies? Is because I think everybody on this call, on this webinar, wants to create wealth for their families and their communities. And I want to reiterate the fact that every decision will either create or destroy wealth in that business and ultimately what you're trying to do for your family and the community. Again, my firm, we try to recover wealth, preserve wealth, and unlock wealth. Those are the things. We're in the wealth building business to some degree. And when you're going to turn around the business, we're trying to recover some things that have gone wrong, and then we're preserving. We're trying to maintain the status quo. And if you're looking to, unlock and create some wealth, trying to transform an organization, your organization, like I said, take advantage of what the SDA has for programming, for resources, and you're gonna be fine because they're there to help. We're there to help. So I don't want to go any further. Let's see if we got any questions, and if I can answer them, I will. And if not, we'll find the answer. We'll direct you in the right place.
Awesome. Yes, Stanley, great information. So much valuable information and insight. We don't have any questions in the chat, which means you did a great job at emphasizing everything and going from high level to also explaining it with examples. So I would like to give you an extended gratitude and thanks on behalf of myself and everyone at the SDA. So thank you, Stanley Jackson from Jackson and Melton, for being here with us today. Also, thank you to Cook County and the Small Business Source, our founders. If you have any further questions or would like to know more about Jackson Melton or ourselves, please reach out to me. My direct line is on the screen, and so is my email. And we look forward to connecting with you. Thank you so very much, and have a great rest of your day.
Appreciate it. Thank you.
Thanks.